thank you for hosting these. They're like clockwork every year, so if we can just maybe give Nick a round of applause. All right, help wake everybody up. I needed to. All right, so the LNG panel. So with us today, Richard Tyrrell, CEO of CLCO, Knut Traaholt, CFO of Flex LNG, and Gordon Shearer from Poten and Partners. So we're going to run through typical industry dynamics. I'm going to ask about some news flow we're seeing in this space as well. But again, it's the first panel of the day. We can make it relatively collaborative and informal, so if you have questions, raise your hand. But I'm going to start with rates, because I was all over the headlines on my train in this morning with, I think, rates in the Atlantic Basin kind of dipping below 50K. Obviously, we're a bit below average on the LNG carrier side heading into winter, and Europe looks relatively well stocked. There are a handful of other factors out there, obviously, but I thought it may be helpful just to kick things off, just to go one by one and get everyone's rate outlook for both the near term, so consider it winter, kind of 24, 25, and then the next 1 to 2 years, when you can start kind of pulling in some other factors we're seeing, be it congestion, deliveries, project deliveries coming a bit early, and the like. So maybe, Richard, do you want to kick off and maybe give a little bit on what you think about the rates?
Sure, happy to. What I'm going to bemoan today is a complete lack of volatility on the commodity side, and that is having an impact on the shipping rates. Hopefully in the short term, because volatility can always come back. But let me just explain what we're seeing at the moment on the commodity side. And that is quite a high TTF price. Now, TTF is the price in Europe. And if you look at the forward curve for TTF, it's basically flat across the winter season. And that's not good for shipping, because it means that there's no contango trade and no need for storage. So that's on the one hand. On the other hand, you've got TTF rates or prices in Europe which are relatively high and more or less comparable to Asian JKM prices when adjusted for shipping. So that means there's no east-west arbitrage either, which again isn't great for shipping. What are the root causes of this? Well, the high TTF prices at the front end of the curve in Europe are down to a couple of things. One is the fact that Norway had outages for much longer than what they typically do at this time of year. So it's actually left Europe not quite full, which by this time of year you'd expect it to be full from a gas storage point of view, and it's not. So that's one aspect that's having an impact. And the other aspect that's having an impact is the uncertainty around what's going to happen to gas volumes that are flowing through the Ukraine at the moment into Europe. And that is through a long-term transportation agreement that's set to expire at the end of this year. No one's quite sure about whether it will be extended. Obviously, Ukraine gets revenue from that, so there's reasons to extend it, which might be contrary to what you might think. And the uncertainty around it, in a nutshell, is pushing up the front end of the curve and reducing any contango and any sort of need for storage, which is what we'd like to see as a shipping company, of course. Now, so that's the story, and our thinking is that it will change at some point, and then we'll also see more volumes coming online in the US, Shearer and others, and maybe I'll let my co-panelists talk about the other volumes that are coming on. And when they come, those combined with an unwinding of the other effects that I just took you through ought to improve the shipping market up to a level which won't be like it was before, but it'll be a downside better than what it is today.
Yeah. And I think to add to sort of the outages or the scheduled maintenance in Europe is Europe for the last 2 years has been saved by 2 very mild winters. So there's one factor this year is, will Europe be saved again? if you come to the charter rates and sort of short-term, mid-term, and long-term, obviously shipping is affected by supply of ships, and that volumes coming on stream will come later. And there are a number of ships coming this year, and next year, and thereafter. And so unless you see geopolitical events or outages, shipping rates in the short term will have an effect on it. And I think that's what, at least for Flex, we've been looking at since basically 2022. And we've been worried about the impacts of deliveries from a new building order book, and therefore also secure the long-term contracts to isolate ourselves from it. There's about 70 vessels this year, 85 next year, and then another 85. And you can always already see the impact on sort of this winter. At this time of the year, for seasonality, the rate should have been higher. But there is a number of ships available, and that impacts the short-term rates. If you look at the long-term rates, and both Richard and myself, we're looking for sort of the 10-year rates, which is compared to the new buildings. And that's probably a startup for 2027 or 2028 when the volumes are coming on stream. So new building prices and interest rate is the main driver for the 10-year rates. So now probably new building, you can get a new building at $260 million. If you have a good connection with the yard, maybe lower. But that's down about $5 million from the peak. And interest rate has also moved slightly lower. So you'd see now that the 10-year rates has, from the peak of maybe $105,000 per day, are down to sort of $92,000 per day. But for a 10-year rate, if you're looking at an existing ship, maybe you can be more flexible on sort of charter terms than a plain 10-year. We're more than happy with those rates.
And Gordon, you're the only one here without a book to pitch, so no pressure.
No, I'm not going to pitch a book. So building a little bit on what Richard said, I think one of the elements that's playing in the TTF equation too is that we've added so much import capacity in Europe that the cost of unloading a cargo in the European terminals has gone down dramatically. Maybe from close to $1 last winter to around 20 cents right now per million BTU. So it's been a huge drop. So although the headline TTF rate has prices come very close to JKM, the cost of moving a cargo into the TTF market has dropped even more dramatically. So that's another factor that's weighing into that. On the flip side of that coin is Asia. China's weak. The Chinese economy is not growing at the rate people are expecting, and demand is not growing on the gas side, LNG import side in the Chinese environment. You're also seeing some, at these price levels, you're going to see some struggles in the emerging economies in Pakistan, Bangladesh in particular, where much more price-sensitive markets. And then the other market, which is really sort of jumped up dramatically this summer, has been Latin America. Brazil has expanded its rate of imports given relatively low rainfall because Brazil is a hydro-powered economy, and with hydro down, the substitute is to bring in gas or run gas-fired power. So a lot of gas being added to the generation mix in Brazil is pulling LNG in as well. That means more ships are staying in the Atlantic, which is less ton miles out of the US as the swing supplier rates, more ships, rates go down. But most of what we see in the activity on the rate side is not actually owners chartering out, but it's subcharters from charterers who are holding the existing positions on the ships. So for them, it's more of a trading equation than it is the economic equation an owner's faced with. Longer term, I think the one thing we are concerned, nervous about in the medium to long term, is speaking about geopolitical uncertainty, is the political regulatory and legal uncertainty surrounding U.S. LNG projects right now. This is a big issue. And we can talk about that some more, but if we see a slowdown in the U.S. and the rate at which U.S. volumes come to market, we're going to see a big overhang of ships built in a very, very short period of time.
Can you talk a bit about the Cool Tiger? One of the handful of ships within public companies that are going to be exposed to the spot market. What kind of interest are you seeing for it, both in terms of volume and tenor, and how are you approaching it?
Yeah, I mean, the way we think about our open ships is that we certainly don't want them all coming open on the same day. So the way you manage the risk is by having a portfolio of contracts, and you don't. We've got 13 ships. We've got only 2 coming open this year, and then another couple next year. So we look to space things out. That's the best way to manage the risk. This is not a great fixing market. Mm-hmm. It's even though there are long-term charters available, of course, sentiment plays a big part, and when the spot rates and even the short-term rates are what they are, it has a knock-on effect on the long-term rates. And it enables people to sort of push back their requirements and bridge the period with spot vessels in the meantime. So it is going to be a bit challenging. There are things available. The question is, are they available at the price that we want to do them? And this is where we have to strike the right balance.
Makes sense. Knut, you mentioned in your first response some of the geopolitical risk. Obviously, we're also seeing a significant amount of congestion around the Panama Canal. I'm just curious, between those 2 factors, which do you think is either the biggest tailwind for rates, or the potential to help rates, and why? Which of those would you lean into more?
Yeah, maybe first just add into sort of the general dynamics of LNG shipping compared to other segments, because sometimes that is maybe not really understood, that there is no really active spot market with independent ship owners. Most of the vessels are controlled by the big charterers on long-term contracts, and the same goes for the new building order book. About 93% of that order book and the ships being delivered are already secured on long-term contracts for the ship owner. So it's more the inflow of new vessels where there is available capacity that the charterers will do to sublet. So if you look at in the spot market, the ones who are active doing these spot market shorter term contracts is basically a sublet from a charterer to charterer. So if you are an independent owner and with spot exposure, you're basically competing against your own clients. And that's where it's more challenging to do a spot market activity and short-term contracts in LNG shipping compared to other segments like the VLCCs and the bulkers. Mm-hmm. On geopolitical risk, if you look at the closure of the Red Sea, or basically no trading there, that impacts mostly the Qatari volumes going to Europe. For the US volumes going the long route to Asia, it takes a bit longer time, but at the moment there are more than sufficient vessel capacity to take those extra days. And then you can always question, is there a cost element of doing it? Mm-hmm. Well, the Suez Canal authorities, they are clever. They can calculate the longer route and then they price it thereafter. So cost-wise, it's not necessarily a benefit, but you can save some time going there. But for the moment, there's no rush in the LNG market to save those extra days.
Gotcha. So Gordon, I want to move back to subcontracting. I'm going to pull it forward just because it's come up twice already. But if you think about the dynamics we have in place with current projects, right? So if you think about the delays we're seeing in the U.S., obviously our team in Houston is already forecasting delays across almost everything being built in the U.S. right now. The one area where we're not seeing delays is in Qatar. All right, so if you think about who's taking those volumes, right, and the amount of subcontracting that's going on now, if you do see that dynamic persist and you see Qatar come on time, U.S. volumes come on reasonably late, Does that subcontracting dynamic where ship owners are competing with their customers, is that poised to get worse over the next couple of years?
Yeah, I think it will, and because, and of course it's much harder to line up U.S. projects with shipping because the offtake is on an FOB basis, whereas Qatar is controlling its entire fleet and selling on an ex-ship basis. So the Qataris have complete fleet control of everything and destination control over all the volumes they're marketing. So they're not likely, and it's rare to see Nakilat or Qatar Energy out on the sub-chartering market, but I mean, they will do it from time to time. That is definitely not the case with the U.S. volumes, where one, you've got a much more diverse pool of buyers and off-takers. A lot of them are trading and portfolio players in the LNG space. You've got destination flexibility. That combination means that a ship, from their perspective, is every bit as tradable a commodity as the molecules of gas it's carrying. And so, you're going to see people make decisions about how to manage those ships they've committed to, perhaps in anticipation of U.S. volumes. They're now delayed. Those ships are definitely going to be back on the market. And whether that means they're going to slow steam them or they're going to subcharter them, it's clearly going to put downward pressure on rates just because the volumes aren't going to materialize on the original schedule. And that's at least 3 major projects with delays: Rio Grande, the Golden Pass project, and all for different reasons, plus other ones that were close to getting permitted that have been caught up in this pause effect.
Well, I want to stay there for a second because you keep pulling forward topics that I wanted to save to the end, but Rio, right? So you've got a scenario where a regulator has come in, or rather the Shearer Club and a local organization have come in and successfully challenged the construction of that facility under construction. And there's a scenario where that construction actually pauses. It hasn't paused yet, but if the appellate process goes the wrong way or is not stretched out long enough where they could actually pause it, which would give the Shearer Club and other environmentalists basically the ability to shut down construction of a project based on what would amount to a foot fault from FERC. In that scenario, all right, you've got at that point delayed capacity, ship owners that would theoretically be exposed to that. I spent a lot of time thinking about how the LNG and the natural gas markets react to that environment, but from a ship owner perspective and from a shipping perspective, is that just simply a scenario where you're looking at an owner that's stuck in between back-to-back FM clauses and they're exposed there? How do you think that'll actually play out from a shipping perspective?
Well, there's about 15 questions in there. So let's try and unwind them a couple of things. First of all, Rio Grande is not a victim of the Biden pause, it's a victim of the legal system. And Rio Grande's problem is the Court of Appeals has determined that FERC reached the authorizing order on that project without due consideration and has basically done something unusual, which is they've vacated the order. That is, they've said the order is invalid. Now, there's a scramble on at the appeals court that we may see resolved in the next couple of months, but Rio Grande has pulled part of its application out of the FERC, and it's trying to reposition itself to go to the appeals court to undo the vacation order. But if the vacation order stands, construction will stop, and probably for an extended period of time, a year, maybe 2 years. And there's precedent for that. The Mountain Valley Pipeline, which was 80+% constructed, the order there was one of the minor permits was vacated by the Court of Appeals and shut down the whole project for 2 years. So that's not undetermined. And Rio Grande, 3 trains, that's 32 ships right there that people are counting on coming on stream starting 2027. These move out to 29, that doesn't look so good. Golden Pass, you've got a bankruptcy of the contractor. They are restarting and reconfiguring that, but that's another probably a year delay in Golden Pass. Port Arthur, people don't pay attention. Port Arthur's air permit has been challenged and in the Court of Appeals has been granted illegally, and it looks like that may also be under some stress. So And so what we're seeing is, while I think everybody's focused on this Biden pause, which affects the projects that haven't yet reached FID, there are a lot of challenges on the ongoing projects in construction that have all sorts of uncertain outcomes.
Richard, you're going to answer.
Yeah, maybe just a few sort of comments on how the actual contracts work, or the charters work in this sector. There isn't really a concept of FM on the shipping side, because the logic goes that if you can't use a ship on one project, you can use it elsewhere in the world, and there's a market for that. So, what happens is that if these projects get delayed, it's not a problem for the owners who have got ships assigned to these projects per se, but it means these ships pop up in the spot market, which we've already gone into in some detail. But this is not a new phenomenon. All the VG volumes, all the charterers had ships for those volumes, and then of course they didn't get them. So these sublets have been weighing on the market for some time as that issue has played out. But I think the big sort of known unknown at the moment is this Qatari question, and they've got something like 120 odd ships on order now. So a big part of that order book is Qatari ships, and the big question is, are they going to park them like in a big taxi lot off Doha, or are they going to look to use them elsewhere in the world? And historically, they never have. They've always wanted to reserve their own ships for carrying Qatari molecules and not carry the molecules of others. But those ships will be sitting there off Qatar, and they could easily shift that strategy and look to lift other molecules. So I'd say of all the kind of concerns that I have, that's probably the largest.
Knut, anything to add there?
Yeah, maybe then slightly on the upside, because even though it's a classical thing that ships come first and projects are delayed, and unfortunately history repeats itself. But there are a number of volumes here that there are counterparties that don't have secured shipping capacity, and there are charterers that see that they are lack of ships from 28 and onwards. And some of these, they are committed for volumes where they're basically doing an assessment. They have time now to order a new building, but then they're committed for 10 years. And then they can look on existing modern vessels on the water for more flexible contracts or flat out 10-year plus as well. So even though that maybe chartering activity for long-term contract has been sort of slow since the spring of 23, now you see that there are more incoming requests for tenders. It's sort of a bit of a wide range of what they are asking for. It's everything from 3 years to 15 years, and they ask for everything in between. But there are, you see that there are more incoming requests coming, and that's basically to start to fill up shipping capacity they need from when the sort of the scheduled flow of vessels are coming. If there are delays, well, 1 or 2 years, if you have a commitment for 10 years, you can't sort of bet that it will be delay, and then you're suddenly short of ships. And then on the other side, if this will be pressure on the short-term rates, that will have the effect for the 200 vessels from the steam fleet. And maybe you will then start to see more of an accelerated scrapping of it, or taken out for other type of use, if it's for storage or for import terminal conversion, or unfortunately if it ends up in the Russian dark fleet.
That's helpful. And just maybe one note for the audience. I could probably talk about project dynamics all day, but with regards to Golden Pass, Port Arthur, you're right, their TCQ permit was pulled. So construction hasn't stopped at any of those projects, right? So they're all trying to be worked out mid-construction. So what I would keep an eye on is if construction stops and the capital flow stops, then you have a significant issue. At this point, right now, everyone's trying to work through it in tandem in a parallel way. But to Gordon's point earlier, it's not just related to the DOE, it's related to local permitting, it's related to FERC. There are a number of brush fires across that entire space at the moment.
And look, I think most owners, they are quite sophisticated when it comes to looking at the market, and we all run models where we handicap these projects. Some of us look at Mike's work on the same. And if you look at that and you look at where the volumes are coming, you look at where the volumes are going to, you net off the steam vessels which are leaving the fleet, then you do very much get to the point where it will be a market which needs more ships in the 2027 to 2028 type period. Mm-hmm.
So one quick one when we're on this topic, then I want to move to some geopolitical questions or some really demand sync questions. But one of you all mentioned Calcasieu Pass and the very public Shell, VG, SPAT. It's really VG with most of their counterparties. I'm just curious to get the ship owner's perspective on what you see there. You're stuck in the middle to some degree, and I'm sure you don't want to extend yourself too far in terms of commentary, but when you see that happening, playing out between potential customers, and you may or may not be stuck in the middle, what are your thoughts?
I mean, look, it's been a long time, and we haven't heard how that case is going. Obviously, as a result of that case, people have been tightening up the language in these agreements. So it's not like something that we'd expect to see on a regular basis. But what the outcome of that case is, I'm afraid I've got no clue.
Fair enough. I wasn't expecting a big answer there, but I had you guys here, so I wanted to at least ask. Maybe moving towards demands. And Gordon, I think you mentioned Chinese import growth. So it looks like year on year, at least year to date, we're up a bit. Not hitting the level that we wouldn't necessarily want. Still very high single digits. Actual imports are actually up a bit more, but a lot of that's piped. Just curious, when you look at the market and you look at demand sinks, obviously stocks in Europe are full, but we've had, to Knut's point, 2 very warm winters back to back, right? So that can change in a hurry. But when you look at the intermediate to long term at demand sinks, where do you think most of this gas is going to go? And I'll ask you that first, and I've got a follow up.
So I think clearly we have had a huge uptake in Europe post-Ukraine crisis, post-Russian gas being cut off. But assuming, and this may be a very big assumption, that Europe politically manages to stay on its decarbonization track, and that I think is a huge question. That's, they're going to have conferences about that, so we don't have enough time here to talk about it. But if Europe stays on that decarbonization track, LNG is going to get squeezed out of the European market. The other thing is that, remember, one of the things I think is very critical in Europe is the effective price of LNG imports in Europe are much higher than what Germany especially was paying for Russian gas. And as a result, what you're seeing is a real downturn in industrial energy demand in the German economy. And whether that's temporary, and this will come back, or it's structural, and we're going to see those energy-intensive industries pushed out of the European market entirely, is a huge question. And that will drive, in some measure, long-term demand in Europe. If long-term demand in Europe goes away, then we are, or it gets pushed down anyway, we are now headed towards the Latin American market, the emerging Asia-Pacific markets. And those present a different set of challenges and opportunities for the LNG exporters and sellers. Mm-hmm. And it then becomes much more, and it's a much more price-sensitive market too. Mm-hmm.
So demographics would suggest that downturn in Germany is systemic, right? That their population curve is upside down. Same thing in China. I'm curious, you didn't mention India in that answer, right? Which, to be fair, is where maybe some of these owners, and especially guys like me, have had our ass handed to us for 5 or 10 years now. But it is the one large population center with the right kind of demographic curve and energy needs. So I'm just curious, one, Gordon, when you think about demand sinks, where does that factor in for you? And then for Knut and Richard, I'm curious what kind of activity you're seeing in the shipping markets and how you think that could play out over the next 2 to 3 years or longer.
Well, I think India is clearly a huge player. And the real question now, we're into a much even bigger geopolitical issue than that, which is what is the world going to do about greenhouse gases? Because India clearly is not slowing down its consumption of coal anytime soon. And it has a lot of the ideal conditions for renewable energy resource development, which are questionable. And you see some of the dynamics playing out in the adjacent countries. Pakistan, last year, I was shocked to hear Pakistan last year importing 13 gigawatts of solar panels. And what's happening in Pakistan is solar panels are so cheap that industries and houses are putting them on their roofs and bypassing the grid, which ultimately means electricity demand from the utility sector is going to go down because consumers are going to put their own generation on their roofs. If that happens, and 13 gigawatts is massive. That's a third of the Pakistan power market. Bangladesh owes $600 million in unpaid LNG import bills. This is the risk of working in this emerging market, highly price sensitive, susceptible to all sorts of economic turmoil. India, much less so, but India, to me, has always been a market that promised to import a lot of LNG and always will. It doesn't never quite seem to materialize in the volume and scale that you would think it should, given the demographics, the economic growth, and everything else.
It's like soccer, the sport of the future since 1975. Right?
Well, but just jump into the assumptions. There are two big ifs, and maybe not so much of an if anymore. Europe is trying to decarbonize, but it seems both they are struggling with the energy trilemma. They will not make it on the cost side. And so that rollout of green new energy will take longer and will be more expensive. So there is natural gas to replace that, at least as a base load into the electricity system. But as you rightly point out, the energy-intensive industries in Europe, in particular in Germany, they are exporting themselves, or they are moving. And it's highly likely they will move to like types of the US, where you have abundant, cheap natural gas. So unfortunately for Europe, the industry is shrinking. India is 30 years behind China. It's very promising market, but obviously it's a different political system and it will take time. But you see now that there are distribution pipeline development to spread out and distribute LNG to a wider part of India. Obviously, that will take time, but if you look long term, India is also a very interesting market. But you have, like China, they have access to coal, but over time, when you want to lift a population up into a sort of higher economic status and living quality, you can't disregard air quality. Most people are talking about coal as for greenhouse gases, but I think it's more important in the first round to look at air quality. That's where you have voters that will complain. They will think more about air quality today than greenhouse gases 30 years down the line.
Look, and I just encourage everybody to be a little bit patient with regards to this demand. The last few years have seen very, very high LNG prices, and that hasn't been conducive to growing the demand in these markets. The LNG price will come down. We've got the volumes that they're increasing year on year. The prices will come down, and these countries will take the LNG. Otherwise, in Pakistan, it's all very well. They might have the solar panels, and that gives them power in the day, but what are they going to do at night?
And that's where in any commodity market, low prices generates new demand. And for Asia and Southeast Asia, if you can have you can have access to LNG at affordable prices, it will be consumed.
Yeah, I think people underestimate the price elasticity of demand in this space.
fair enough. We got a
And
couple.
then just maybe adding one thing on, we mentioned here coal and China. When I talk to Chinese counterparties, and I ask about the coal to gas switch in China, why it's not happening faster. They have access to long-term offtake agreement of US LNG that has mostly been traded to Europe. But the Chinese economy is struggling, it's slowing down. And the coal industry, the domestic coal production, is a large employer of Chinese people, which have limited to no alternatives. Mm-hmm. So it's a political decision to keep that industry also alive. It's a cheap and reliable source of energy, but you also, it also employs a lot of Chinese workers that have limited alternatives.
Just a couple minutes left, and I want to turn back to ships and the actual asset values here. But I think you mentioned vessels around 260 million, maybe a little bit less if you know the owner. I think the last print was 257. I'm sure everyone on the stage or dais here remembers that asset values hung around 200 million plus or minus 5 for about a decade before really ratcheting up with inflation. So in general, do you think owners at this point are getting compensated for that cost basis at the moment? Have returns inched down from where they were 4 or 5 years ago?
Yeah, I think owners are being compensated, but that's because the vessels that are currently being fixed didn't cost 260. Mm-hmm. And this is a market where the owners with the cheapest vessels fix first.
Sure. For the last couple of years, owners have been compensated, and but if you look at it's all about if you look at the new building price and the 10-year charter rate, it's not an easy decision to make that investment. It gives you a decent return, but then it's all about what kind of residual value risk you're willing to take. So obviously there are when you come to long-term contracts, it's a hard negotiations, and as more vessels being available, you will see that pressure on the short-term rates. But I think that the real discussion, if you're compensated, will come into the more long-term contracts from 7 and upwards. And as long as there are limited alternatives for these charterers, you have more of a fair balanced return on it. Mm-hmm.
So as it pertains to that obsolescence risk, and if I think back to last cycle, where obviously the Moss and even tri-fuels have faced a higher degree of obsolescence risk because the technology curve was relatively steep compared to what was being built, right? If I think about where we are now, say with MEGI or XDF versus what's being built today, and you're making a decision on a new build and a 10-year charter, do you think about the residual value risk on that asset slightly differently today than you did maybe 5 or 10 years ago when you had such a steep technology curve?
If you look at the vessels we ordered and were delivered in 18 to 20, there's limited, there are slight changes that you would add for new building today, but it's not what make it or break it. It's not like the technology shift that you had before. Mm-hmm. So you're already taking out a lot of the technology gains. And if you look at, for example, 9 of our ships are MEGIs, they don't build MEGIs today because it's more expensive. You need 2 extra compressors and probably $12 million. So you would rather build a mega. But then you see the benefits of a mega ship with high pressure, lower methane slip, in particular for trade to Europe when you have ETS and Fuel Maritime EU. We are not that concerned that you would see the same technology shift from a tri-fuel to a 2-stroke. But there is always some more elements you can add to it, but it doesn't mean that we can't add to it at, let's say, on a 10-year special survey, if that's air lubrication, etc.
Look, I mean, I could get into a battle with Knut on technology, but the bottom line is that the sort of delta between vessels is under $10,000 a day, and that is within the kind of window that you can close through pricing. So we're not going to see vessels sort of falling off the merit order and ending up in the scrapyard with the modern vessels like you will see, I think, as we've already covered, with the steamships.
Gotcha.
Yeah, and to be fair, it's the steamships, and it's both on size and both on technology. If you have a modern tri-fuel and it has the right size and it does the long-haul trades, it will perfectly trade in that market. It's more if you have a specific trade to Europe, you might want to optimize it with a vessel that has low methane slip.
Gordon, anything to add there?
No, not really. I think the key question is the steamships. What happens to the older steamships? Do they? I mean, they've been going to leave the fleet forever, but like Freddy Krueger, you can't kill them off, right? It's a nightmare on Elm Street with the old steam turbine vessels. And when we model them out, I mean, yes, they're uneconomic. You're not going to use them into Europe for environmental reasons, but if you're looking at an emerging Asian market, short-haul trades, they make economic sense on a short-haul trade. And as Knut pointed out, they are very adaptable for FSRU, FSU conversion consideration. And I think you're going to see more of that happening. How fast that happens, because FSRU projects tend to be slow to develop, especially in the emerging markets, is a different question.
Sure. That's a different panel.
Different panel.
We're just about out of time, but are there any questions from the audience? Going once, twice? All right, sold. Thank you guys very much for joining us. Appreciate it.
Thank you.
Thank you.